with that, we'll kind of kick things off, and we'll talk through like what are add backs. So when I think about add backs, etc., um, let's set the stage for the buyer's dilemma. So the buyer's dilemma, finding the true business value. So picture this: you're looking at a prospective business, and you see it's reporting 900,000 in net income or net profit. But within that net profit are things like, um, owner salary, personal travel, etc. Um, Things like owner salary, car lease, maybe there's some personal travel, family payroll, or one-time legal. Um, But after the add backs, the owner inflates profit by the owner salaries, a car lease, that personal travel, and family payroll. So when you look at it side by side, they are showing that the business is spitting off an adjusted EBITDA or adjusted earnings of about 1.2 million. It's very important you understand the buyer's dilemma. So if you are looking at a business listing, the business on a reported basis says it produces about $900,000 per year in net profit. But the seller and his team want you to pay a market multiple of the adjusted EBITDA of 1.2 million. So if the business wants 4 times earnings, they're going to do 4 times this adjusted EBITDA amount. So you'll see that all of these add backs are extremely expensive, and you're basically paying a dollar for dollar times four, or whatever the market multiple is, for your deal. So it's very important you understand the ramifications about add backs, what they are, and how, if you don't verify them or if you don't do enough work around them, um, you effectively can overpay for a business very easily, and it can get very expensive quickly. So again, the question of how much is actually in business income. The add backs answer this question. So the reported number isn't really the real number, in my opinion. Um, a seller's 900K profit typically includes personal expenses and in the case of small businesses, their personal expenses or personal burdens on the income statement that very likely are not going to be transferred or used as a new buyer. Yes, for tax purposes, you may take advantage of some of the things these owners are doing, such as running some of their personal expenses on the company. But when you're analyzing an asset or a potential investment in a private company, whether it's a full buyout or a partial buyout, you want to understand what is the true business earnings itself. What is that answer? Is it $1 million? Is it $500,000? The answer really lies in these add backs and the verification or disqualification of these items. So if we think back to the reported versus the after, a seller and his team and the brokers are going to make the case that the business value is higher than the reported, very likely. More often than not, if you go to a business listing, the reported earnings are smaller than the adjusted EBITDA based on some of these add backs. So the question is, how do you validate or invalidate that these things are truly non-business, personal related expenses that should be given credit for? So what is an add back? So there's 3 types of add backs we see often in small business acquisitions. One, non-operating. think of these as not needed for daily operations. The daily operations in order to run the business. So, for example, an owner's life insurance policy is not needed in order to operate the business. It might be needed for insurance. The owner may have taken it out for peace of mind in the event something happened to him to support his family. But the business does not need this expense in order to operate going forward and on a day-to-day basis. Discretionary. So these expenses, think about discretionary expenses, personal travel, entertainment, sports tickets, or other concert tickets that the owner is paying for by the business for personal use. Now, I want to make one thing abundantly clear. When we categorize and talk about owner expenses, I want you to forget about the idea that whether the owner should be doing this or not for tax purposes. Whether or not it's allowed for tax rulings is an entirely separate discussion, and it's one that a lot of prospective buyers get caught and carried away with. For purposes of analyzing the business itself from a profit and loss, whether or not they should be doing this in line with tax regulation is not the point of this exercise. The point of this exercise is to understand what are the expenses of the business, and are these expenses business related or are they non-business related? That's really the question. It's either a yes or a no. If it's a yes, they are business related. They need to be supported by general ledger activity, etc. We're going to get to that a little bit later. But a lot of questions I get about owner add backs is questions about, is this legal for IRS purposes? They shouldn't be doing this for tax purposes. Whether that's correct or not is an entirely different discussion. If you have any questions about that, I'm happy to answer those now because I do get a lot of those in practice. To be the most impactful, please refrain from doing anonymous submissions. It just makes this easier as we kind of track who reached out to us. So in the meantime, I'll keep it moving. So non-recurring. So what are non-recurring add backs? Non-recurring add backs are one-time events unlikely to repeat. The number one thing we see in small business acquisitions that are non-recurring add backs are one-time legal related fees. Think about settlements, significant legal expenses related to a settlement or a lawsuit, relocation costs, etc. The number one thing we see is expenses, significant expenses in a single month or a few months related to lawsuits or legal activity around the business. So it's important when you have an inkling that the company is going through a lawsuit or having significant expenditures related to a lawsuit, you want to understand the nature of this for two reasons. One, you want to make sure that the company isn't frequently sued. If the company operates in industries that are subject to higher lawsuits, etc., that could be an issue that you run into. For example, we were working on a roofing deal, and the company frequently had legal expenses related to suing customers who were delinquent on their payments. At first glance, I categorized this item as a non-recurring valid add back, but after a detailed review, the business actually periodically spent these legal fees, as a normal operating expense. So it was expected going forward, any new owner, whether it's the existing owner continuing on or a new buyer or client, he or she would have to be expected, and very likely they would be paying the same amount of legal fees going forward as these lawsuits periodically pop up. So it's important to understand the difference when you're looking at an expense item and asking yourself the question, is this truly a non-recurring one-time thing that is not expected to happen in the normal business operating a year? Or is this something that comes up every few years? If it's something that comes up every few years, that is not a valid add back. Case closed. In our opinion, it's a cut and dry. It's either truly non-recurring based on a dialogue, or it's something that periodically happens and should actually be removed from a valid add back. So, what are three traits of a legitimate add back? Here are some commonly accepted add backs: excess owner compensation, non-continuing family payroll, one-time legal settlement, which we just covered, personal discretionary spending, things around travel, memberships, etc. Um, some red flags, some questionable gray area adjustments, which we see in practice. These include things around recurring costs, which are categorized as one time. Recurring costs, think about, you know, cyclical expenses or legal fees that we just talked about. Those may be called out as one time, non-operational, or, something that doesn't happen very often, but it very well could be something that happens every other year. The last item, the stacked micro adjustments, that's something that comes up a lot. So if there's several items that are $5,000 each or $10,000 each, at first glance, you may want to give them credit and not spend a ton of time analyzing some of these smaller add backs. The risk is that when you combine these add backs on a cumulative basis, the amount actually becomes material. If we take the example, if there's 10 add backs that were ranging from $5,000 to $10,000, that quickly becomes a $50,000 or $100,000 add back. If you apply this to a market multiple of 3 to 4 times, all of a sudden you're thinking about a purchase price adjustment, which is higher by about $300,000 to $400,000. So be on the lookout and don't necessarily push to the side some of these stacked micro adjustments. In our opinion, every single add back needs to be legitimized through GL support, a proper understanding of the nature of the items, and then really making the decision of is this legitimate or not. Another thing that's not included on here, which is not an add back, which is typically periodically included, is the sale of equipment. So the sale of equipment, unless they are a business that sells equipment as their primary business operations, is not an add back. We see this a lot in practice. Either the company will sell equipment and they'll record it as income, which is incorrect from an accounting standpoint and needs to be pulled out, or they sold equipment, recorded it correctly, but as not income, and they are looking to get an adjustment to raise EBITDA by that amount. If you are pursuing asset-heavy businesses, you likely will see this in practice, so pay close attention to the sale of equipment and how it's treated on the accounting side, as well as how it's presented in the SIM. If you have any questions about that specifically, I'm happy to talk through some real life scenarios. So how do add backs impact valuation and the purchase price? So as the reported EBITDA is about $800,000. The sellers claimed EBITDA of 1.4 million. So they have proposed $600,000 in add backs. Think back to slide 2, where it was the buyer's dilemma. So what are things that added back? What are they trying to add back? Could be personal related. It could be travel expenses. Think about some of those things, maybe some one-time items, if I were to guess. But look how much higher the EBITDA is, $1.4 million. That is significant when it comes to the purchase price. So I'm going to call out here. So if you were paying a purchase price simply based on the reported EBITDA, you would be looking at roughly a $3.2 million purchase price. Not a bad deal. The challenge is the seller is listing this business for 5.6 million. That is a significantly different number when it comes to debt coverage, how you're going to finance it, etc., for the exact same business. So the question is, does this business earn $1.4 million of free cash flow or EBITDA, or is it closer to the reported numbers and maybe they're trying to get some extra credit? This is the dilemma a lot of buyers face who may not be that familiar with financial diligence. The crux of what we do is to validate or invalidate this to make sure your purchase price is a fair market multiple based on a true verified EBITDA. So taking this example, based on the $600,000 of add backs, we were only able to independently verify and support 50% of those numbers. So $300,000. That was through discussions with management in line with proper accounting procedures on valid and invalid add backs and deeming them recurring or non-recurring. And that is a very different looking business when it comes to the final purchase price at the time of closing. So if you're thinking about, why should I get some counsel? Why should I be doing this analysis myself? This is how folks overpay for businesses in small business acquisitions. If you were to take their add backs at face value and pay a market multiple based on the claimed EBITDA, you likely would get to closing for this business. No problem, $5.6 million, maybe take out an SBA loan and a pari passu loan since it's over the $5 million limit. The challenge is 12 or 18 months down the line, if the business is really spitting off an EBITDA of $1 million, you very likely will enter a cash crunch and you may not be able to support the debt financing you took out in order to pay these loan payments back from an SBA or conventional loans. And that is how a lot of folks default and go bankrupt on their new business acquisitions. So it's very important, you as a prospective buyer, if you're a self-funded searcher or a sponsor, take responsibility in either hiring proper representation from an accounting standpoint and legal standpoint, or conduct this independent analysis yourself to verify this EBITDA number based on the seller's claimed EBITDA. In my opinion, this is something that's often overlooked, and bringing in a third party who does this for a living, like OAG, is a way you can minimize risk for your deal. If you think about the difference between paying $5.6 million, $3.2 million, or $4.4 million, we're talking about plus or minus $1 million applied for an SBA loan. I mean, this is significant monthly loan servicing. You can adjust upward or downward if you don't get this right. I'm going to pause. If you want to scan this QR code, the Business Buyers Toolkit is something we put together over the last few years. We use this for all of our deals. It has things like the checklist, the staging of due diligence, the roadmap, a financial data checklist. If you want to scan the QR code, you'll receive a copy of this today.
Hi, Patrick. Can you share the poll question? I can see it from my end. Thanks.
What was that?
The poll question, I can see it from my end. Can you share it,
Yeah, sure.
please?
Thanks. So, in order to tailor the remainder of the conversation, I wanted to see who we have in the audience today. So, where are you in your business search process? Are you under LOI, actively searching, or just starting your search? If you want to, press one of the buttons, it helps, us tailor the conversation accordingly. I'll give you all, 30 seconds to fill it out. All right, so it looks like we have a few folks that are under LOI, actively searching. So appreciate you all filling that out. Um, so what are some common ways sellers overstate earnings? Typically, a single seller add back is not going to materially inflate earnings. It's death by a thousand cuts. It's the several ones that stack up against each other. So we kind of talked a lot about this, but some other things we see in practice are um, partial year extrapolation. So if, periodically we'll see brokers or seller representatives trying to create a run rate for annualized earnings going forward. If the business had the best 3 months of its history in the past 3 months, they may try to make a case that the business is projected to do $10 million in revenue based on the last 3 months. Those type of go forward pro forma adjustments, in my opinion, should not be considered when it comes to valuations. Yes, the go forward prospects of the business is great and all, but you should be paying based on historical earnings, which have been proven and verified at the accounting statement level. This is entirely dependent on the industry you're working in. So for small business acquisitions, you want to look at historical periods if you're purchasing legacy businesses. If you are a venture fund in Silicon Valley, obviously the go forward rate and the last 3 months of a startup is an entirely different discussion. So think about those two things. Um, Pulling revenue forward or trying to do some funky accounting with costs is something we'll see how they overstate earnings. Um, on the expense side of things, when the company fails to record certain expenses, it due to error, you know accident, etc., it may inflate earnings. Working with a CPA provider to do some analysis will help you verify some of these costs. So pay close attention to this slide because I think this is the most important. So how do you normalize and conduct this process with confidence? So let's take an example. You see the add back schedule. How do you verify, or how does a financial due diligence firm validate or invalidate these add backs? So let's say we have an add back for travel expenses of $50,000 in 2025. You see that number on a single cell. We are going to request general ledger detail for the underlying amounts of that 50,000. So we're going to start at the GL. We are going to require additional documentation. So we might see where those items appear on the bank statement. So if they're expenses, they should be appearing as disbursements, or if they're on the credit card, you're paying off the credit card and the cash is being dispersed from the company. Um, the general ledger test, we're going to scan for the items and understand the nature of these items. So if they say it's for travel expenses, or one-time personal expenses, we want to see in the detail, what are these expenses related to? Um, if we see, truly like family vacations or travel expenses, non-business related, those types of items and documentation in the general ledger will give support that these are really valid personal expenses. When you're doing the general ledger test, if you see things like travel to conference or expenses that might be business related, uh, uh, conducting the GL tests is an easy way to validate or invalidate it, because it shifts the responsibility to the seller to prove, why are these valid add backs and non-business related. If they're not able to prove it at the general ledger detail, you should not give them credit for it. Case closed. Um, the reason why you should not is, if you are going to pay $4 for every $1 of their general ledger, add backs or personal expenses, they need to be able to prove it. You need to trace it back to the claim source documents. So you need to shift responsibility to the seller, and their team to provide the support and make it a clear-cut, simple, you know, process of, we need general ledger support, invoices, etc. If you're unable to provide it, unfortunately, we can't give you credit. Um, Framing it in that way shifts the responsibility very quickly. You then will apply the recurring test. So if the item is being claimed as a one-time event, you want to use the recurring test. You want to ask yourself, is this item truly one time, or is it recurring? You want to ask questions about the nature of this one-time item. Get them talking. Try to expand the historical period. Ask if they've had this expense in the last 5 years or 10 years. If they begin to paint a picture that's different and it doesn't pass the recurring test or non-recurring test, that is how you invalidate these items. Um, it truly needs to be a one-time event that is not expected in a normal business year. Owner compensation. Benchmarking owner compensation is a way to address the owner add back discussion. So in practice, what we see is owners will add back their salaries. If we're talking about SDE, they'll say things like, technically seller's discretionary earnings is an owner benefit, and what I pay myself should be removed from the business. Um, the argument around that, in my opinion, should be, if you are going to take on this business and assume their duties, you likely are going to pay yourself the exact same amount as they have in order to, support your family, support yourself, or replace your prior income. So it doesn't make sense for you to pay market multiple for owner compensation when that expense is going to be burdened going forward. If there are related party items you've noticed, things like rent, services between owner affiliates, you want to understand, what is the nature of some of these items. If there are services between owner-related businesses, you want to understand, what is the true market rate for these items, and are you being charged accordingly? So, what are some of the key takeaways as we kind of close this out? Um, some of the key takeaways are you want to get to the true earnings. What are the true earnings of the business? The seller profit may include things like personal costs, etc., but you want to get to what are the true business earnings of the potential acquisition you're pursuing. Not all ad backs are created equal. Some ad backs are legitimate, many more are illegitimate, whether they're not being actually expensed in the income statement, they're not one time, they are expenses they're trying to get extra credit for, and you're actually going to have to pay for those going forward. Um, Keep in mind that every dollar in these ad backs moves the purchase price. Go back to our example. At a 4 times multiple, if there's $300,000 in proposed ad backs, you you are inflating the purchase price and paying the owner and his team $1.2 million for the $300,000 of ad backs they're claiming. So you need to detail, examine, and legitimize every dollar of these ad backs. And if they're not, they need to be removed from the purchase price and the deal needs to be renegotiated. Sellers overstate. They know the tactics, brokers know what to do. You need to have proper representation in order to, one, set the stage for what a proper ad back looks like, create that third party dynamic so you as the buyer don't break goodwill with the seller. And you need to have this discussion. And you need to normalize with discipline. So if you need to go back to the process of if you are trying to validate these yourself, you need to start at the general ledger detail, do the bank test, do the related party test, do the recurring test or non-recurring test. If you feel like these analysis are not your strong suits, you're not alone. Uh, the bulk of our work is done validating or invalidating ad backs based on our years of experience and our team of CPA accountants. This is what we do for a living. So if you were to work with someone like us, rest assured that we would do this on your behalf and then negotiate on your behalf.